Good morning, everybody. 9:30. A very warm welcome to you, and thank you for joining the fourth in the series of these FD webinars. This one is Accelerating Growth Through Acquisition. My name is Nick Farmer. I'm a tax partner here at Menzies and have been hosting this series. And I think this webinar is really acknowledging that organic growth may not always be the best way to actually achieve your objectives. Organic growth, yes, it can be controlled, perhaps less risky. It's often sort of sustainable, but it may just not sort of capture the market opportunities that are out there. Acquisitions, of course, they can lead to new markets, potentially take you into new geographies, acquire talent, find new technologies. So it can often be the way that drives your business forward. But there's issues there as well in terms of different cultures, how you integrate, the capital cost of doing it, and all of those issues are things that we'll pick up on as we go through the discussion. So we aim to finish by 10:15. If you do have some questions, please put them in the chat and we'll try and deal with them as we go through. And we will send out a recording. I can't actually hear Ali. So for some reason, I can't quite pick you up. So maybe Gareth, can I just move on to you?
Sure, no problem. Good morning, everyone. So I'm Gareth Purnell. I've had 26 years in various tax, treasury and finance roles. And my background in respect of M&A spans quite a large plethora of sectors and industries. I've seen the good and I've certainly seen the bad, having just finished with Kazoo, where rapid M&A, both from a UK perspective and mainland Europe, was effectively brought about the demise of the business, and we can touch on the reasons why later. But I've done music deals. We purchased Beyonce's dad's music label in North America just as Destiny's Child were disbanding. I was at Sky for 13 years, multiple content deals when content was king. The EasyNet deal, which is now Sky Broadband, and also the purchase of Sky Italy and Sky Germany, which again, we'll touch on later as regards do's and don'ts, but also in respect of tax planning opportunities, which I know we will pick up on, and also in respect of financing of those. Okay,
brilliant. I'm just going to check in with Ali, see if you're back.
Can you hear me now, Nick?
We can do, yes.
Apologies for that, everyone. Good morning, everyone. Hi, I'm Ali Peerboy. I'm a qualified accountant, spent the last 20 years of my life working mainly in the technology sector with startup and scaling businesses in the UK, US, and recently in India as well. I've been involved on both sides of the M&A side, on the purchase and the sales side. And I think over the last 15 years, Nick and myself have probably worked on 30 to 40 transactions in that time, maybe a bit more, Nick. I don't know, I can't remember. A lot.
Yeah, no, lots obviously of exciting transactions that we've been part of, and same for you, of course, Ross, in terms of the advisory side. So perhaps you can also introduce yourself.
Thank you, Nick. Yes, my name's Ross Wiggins. I'm a partner here at Menzies, and I actually lead the deal advisory team. As a team, we act not only on the acquisition side, but we do disposals, fundraisers, so we understand both sides of the transaction, which I think is very useful when you're coming into certainly on the acquisition journey. My key focus is on acquisitions and on buy side, so I lead all the financial due diligence assignments for the firm and help with that acquisition strategy. Worked on a huge number of deals, been involved in deal advisory for almost 20 years now, so yeah, huge number of deals that we work on. Such clients that we act for, very large corporates, especially when they're buying owner-managed, privately owned businesses, because there's importance difference between the cultures. Act for private equity, banks that are funding transactions, or as I say, private equity where they're investing in those transactions, and also smaller entities that are actually embarking on their acquisition journey. So we've got a great breadth of experience on how to help advise our clients.
Okay, brilliant. And just picking up on that then, Ross, from the advisory side, you've obviously advised lots of business. What do you believe are sort of the key components, key sort of elements to actually the sort of the pre sort of acquisition stage? What should people be thinking about at that point?
That's a very good question, Nick. I think the key point is and before jumping into any acquisition strategy, is actually understanding your own business. So are you ready? So what do I really mean by that? Well, you've got to understand where your business is within its life cycle. What components do you need to look at? Where do you want to get that growth? Where do you want to supercharge that growth strategy? Then you need to take a step back and think, how much capital are you willing to spend? How much money do you think you can raise? Which are all parts we can go into as we go through this webinar. What is your appetite for risk? So especially if it's your first acquisition, or if it's your later acquisitions, how much of that capital private equity that you're raising you're willing to put into the deal? How robust are your back office systems? So have you got the accounting, HR? So not only monitor your own business effectively, but then be able to assess the impact of the acquisition to make sure that post-acquisition you can operate and integrate effectively. And we'll come on to that a bit more in this webinar. Also, just making sure that you have the time set aside, because any acquisition is going to take time. It will absorb a lot of effort, thought, because as you go through an acquisition, they're never smooth journeys. Even with the right advisors around you, you will need to be pretty hands-on towards the end of a transaction. And make sure you've got a clear strategy. So all different businesses will all have different strategies. Make sure you understand your own, and be prepared to also then, whilst you might have an answer that this is what we want to do, can you find the right entity? It can take time to find the right business, but then be prepared to pivot, because an opportunity can come along that can be interesting, that can be slightly different to what you originally thought. I would then also say, I'm sure we'll come on to this and Gareth can speak, tax structuring, make sure your business is set up to absorb the transaction, don't lose sight of that. And then also, as we'll come on to later, have the right advisors in place that can help you understand your own business, the acquisition journey, post-integration is all critical.
So picking up from that then, need to do some due diligence on yourself, need to be patient to identify, potentially the right sort of target. Gareth, you mentioned you've been through this process a lot. You talked about some do's and don'ts to begin with. At this point where you're sort of looking to go into an M&A deal, what are some of those do's and don'ts, do you believe, at this sort of point in the process?
Yeah, so I think, if we look at from a growth phase or during the growth phase, there's a massive risk of taking your eye off the ball. There's the big shiny box syndrome where you've identified something that will be enhancing to your overall business, be that location or product or service or whatever. Going through that growth phase is the risk of taking your eye off the ball locally. And again, I use the example of Kazoo. And that was really a case of just over expansion, both in the UK, but also entering mainland Europe, of trying to grow the brand and grow the business. But, to pick up on the points that Nick's touched on, firstly, that strategy point, it needs to be part of a wider overall strategy, not just a knee-jerk set of acquisitions. And appreciate, and I completely agree, Nick, things do just come up that you want to go after. You can have a lovely laid out plan, but sometimes reality gets in the way. But also the cultural piece, and particularly if you're heading outside of the UK for your acquisitions, the culture is both from a national perspective, but also from a company perspective. How is this acquisition going to land with the local teams? Case in point, Sky Italy, Sky Germany. And we'll touch on some of the other points around the kind of messaging from leadership, but that was very much set out as not a takeover. So you've got two autonomous businesses in Italy and Germany that are used to doing things their way, and they've been told from the exec that nothing will change. And you're in the UK trying to overlay transfer pricing and maintain tax structures, and there's just a natural pushback enforced by the message that's come from the exec that they don't really need to. So I think it's those things. But my key point would just be, don't take your eye off the ball. Resource the M&A correctly, be that through advisors or combination of advisors and your own teams. but make sure you focus on the day-to-day as well.
Yeah, I mean, obviously that's imperative that that's the case. Ali, there's a question that's come in, and I'm going to throw this one at you, but I know you're well sort of suited to answer it. What do you believe are the best methods to identify suitable acquisition targets?
That's an interesting question. They come from a variety of sources, right? Quite often, being in an industry, you will be aware of opportunities that exist or businesses that potentially could be acquired. You might even get an approach with your advisors. Sometimes they will have a bunch of clients and a wide network of people that you can find. I found a lot of the acquisitions I've actually been involved in have been opportunistic. We haven't actually gone out physically looking for them. Opportunities have come our way. I've not been involved in many buy and build strategies. It's tended to be an opportunistic thing, whether it be the ability to acquire someone who's got presence in a market, whether that be geographic or within the industry that you don't have necessarily. Do they have particular contracts that are complementary? Do they have particular technologies that you want to get your hands on? It comes from a variety of places. But what I would say, everything I've heard so far, totally endorse. This whole process starts with self-reflection. What are you trying to do and achieve commercially, right? That's the ultimate goal. And then, how do you go about doing that? Do you have the right capabilities within your organization to undertake such a transaction? And I think the critical point, which I'm glad that people are mentioning here, is the post-acquisition piece. Buying a business is one thing, but actually having the plans in place to do that, to make that a success, is very, very important. To me, it's a process, it's planning, and it's execution. And in that planning phase and the execution, to me, it's all about de-risking the process. How do you go about making sure that the acquisition that you're making actually results in the desired outcome? 1 + 1 = more than 2. Quite often, if you don't get it right, 1 + 1 can equal a damn sight less than 2. And, considering the amount of hard work and years of effort that go into getting businesses to a place where they are fortunate enough to potentially be looking at acquisitions, you don't want to be throwing it away with a lack of discipline at that stage.
Yeah, so it sounds like, you've got to sort of really know clearly in your mind sort of what is success, what are those outcomes you're looking to get. And through going through, that due diligence phase, you've got to also sort of make yourself attractive to the potential target. Remember, this is sort of bringing two parties together. There's no point just trying to sort of take over a target if you're not going to be, attractive to them as well. So you're trying to sort of make sure there's a good sort of fit between the two businesses. Ross, coming back to you on that sort of deal structuring piece then, how would you sort of go about helping clients through this sort of process?
I think stage one, as what Alex said, self-reflection. You need to come back and go, how can you finance that transaction? You need a very robust business plan in place with a forecast. That forecast has to be profit and loss, balance sheet, cash flow, so you can understand the impact of the acquisition on your own cash flows. And then that will help you understand, depending on as you go into an acquisition, what is the value? How's that going to be funded? You need to be able to monitor that and overlay that into your own company and see how it all fits together. Unless you've clearly got a big pot of cash where you can just do it all in day one, but that's another matter. So having that clearly set out is key. Deal by deal is then how you structure. I think you can have a mindset of, this is where we think we're going to structure a deal, but depending on what you're buying and the size will depend ultimately then what is the most suitable structure. You've got two clear types. You've got a trade and asset deal, which tend to work for the slightly smaller transactions because you then de-risk your own position, the tail from the tax liabilities that sit with that company fall away to a certain extent. But it's not so tax effective for the sellers. You've got to bear that in mind. Or you just got a straight share purchase. Once you've got those two sort of key over structures in place on that acquisition, you've then got how much cash do you pay out front, how much is on, say, fixed deferred, and then how much do you want to put on an earn out. And that is where you're starting to spread risk on that transaction. And again, they're case by case. It's going to be dictated by the type of business you're buying, where the value sits. Is it in individuals? Is it in customers? Is it in their supply agreements? How sticky are all of those will then determine how you structure that. So don't ever go into a deal thinking this is how we're going to structure it. You've got to look at each opportunity, assess the risks, self-reflect, and then put forward what you think is not necessarily your best deal, but has some ability to maneuver. The other key point when you come to deal structuring is don't be wedded to that deal structure. As you go through due diligence, things may come out. It could mean you might have to pay more if the seller sees there's more value. But likewise, you might need to see there and say there is risk within this business. We now need to change, and being able to articulate that to the sellers, support it. That's really paramount. So they're the key points, and we go into it in more detail.
Okay, well, come back to you, Gareth, in a minute, because we can talk about the tax side of things. But Ali, just in terms of your experience, the raising finance piece that Ross has touched on there, obviously different ways to do this, etc. What have you seen, the variety, the kind of deals? I know you sort of do a lot around this space.
Yeah, so it's interesting what Ross is saying is absolutely spot on. Before I answer that, just a more fundamental point. What does success look like in deal making? What does success look like? People, I think, quite often make the mistake of thinking it's about getting the deal away at the cheapest price. It's not. It's about de-risking your position during that whole process. And that's financially and commercially, actually structuring the deal so that you can manage the cash flow, the payments that you're going to make. And also the key critical part is making sure that the motivation of the people that you're requiring to be part of your wider business aligns with what you want as a business as well. I don't know, you guys have seen this, but particularly when you're looking at acquisitions sub £10 million, you tend to find one or two of the key senior management own the bulk of the company. How do you keep someone motivated when they've got £4 to £6 million coming into their pocket? And actually, deal structuring is a very key part of that, in my experience. And you know, the other way to look at it, coming back to the comment about, you know, what does a good deal look like? I look at deals as like a Venn diagram. What you want to do is aim at that sweet spot in the middle where everyone comes away thinking that they're winning. And why? Because these are the people you're going to be working with post-acquisition, and they're going to be key to you actually making a success of it. In terms of the sorts of funding that you look at for deals, again, Ross, absolutely spot on. Every set of circumstances is different. And what I found personally is when you get into an early stage of conversation with people, go out and secure and start having your conversations with the various sources of funding that you're looking at, whether it's equity, it's debt, whether it's government funding. It can be a whole bunch of things. And also part of your funding, dare I say it, can come from your deal structure. If you structure your deals correctly, the smartest deals I found are the ones where you're actually using the cash flow of the acquired company to help fund the purchase. If you can structure a deal that way, that's the best way, really, to be quite honest.
Can I just jump in on a couple of points on that as well, Ali, just to elaborate? I think also when you're looking to raise finance, depending on what acquisition you're looking at, if it's a big milestone step change in the business and you're looking at potentially going overseas, as Gareth mentioned before, where you're then lacking the experience of doing that, thinking about them potentially bringing in private equity to sit alongside you, that those deal makers, they've been on that journey, they can put parachute individuals in. That can also be very important and to help with successful acquisition strategy. So thinking about who your finance partners are going to be is critical. Self-assess, does that actually fill some of the holes within your own management team to help supercharge those that growth phase through acquisition?
Thank you, Ross. And Gareth, I think that brings us nicely on to tax. Ali sort of starting to touch there a little bit on sort of using the target to help pay and fund for some of the acquisition, that sort of earn out, sort of deferred consideration model that we see. You've sort of been involved in these tax structurings. What sort of issues have you sort of typically been sort of talking through it, sort of, you know, with the target and the buyer? What sort of issues come up from a tax point of view?
So I think back to your previous point, it's about trying to keep everyone happy. And to Ali's point about the Venn diagram, it is finding that sweet spot. Everyone's got tax considerations, be it the owners, be it the company itself, be it the target company through potential hits going forwards or potential upsides going forwards. So it's really about structuring it in a way that at least attempts to accommodate, as far as possible, subject to commercial considerations, each individual's tax profile. I mean, some of the transactions that I've done, albeit slightly larger, have been around. So Italian purchase, in-market holdcos, where you can utilise something called allowance for corporate equity. So irrespective of using capital to acquire from the local holdco, you can still take interest-like deductions, which kind of speaks to what is the best acquiring entity in your group, if you have a group, but also where to put the debt. Where are you going to get utilisation in full or as full as possible of your interest expense? Are there local considerations around interest restrictions? Are there withholding tax things to, restrictions to consider in respect of making those interest payments? But also, the upsides of structuring things. I worked for a UK headquartered global group. We would capitalise North America to make acquisitions. They would lend out to Swissco. Swissco would lend out to North America. We had a beneficial tax rate in Switzerland, and we played on the tax arbitrage in respect of that to the US. But one of the other things that we'll come on to, as I appreciate we're marching through this, is it's all well and good to put a structure in place day one, and it speaks to the kind of commercial points we touched on already. You have to maintain that structure. You have to maintain that structure. It looks great on a PowerPoint when you're going into something, and no disrespect, but your advisors have said this will work or should work, but you have to maintain that. So you have to be very rigid in your maintenance of structures. So in that instance, a Swiss treasury function has to be governed absolutely. So regular maintenance, ensuring all board meetings documented, minuted, etc., so that you've got a strong defence against the great structure you put in 18 months ago. What does it look like 18 months later?
Okay, picking up on obviously some quite significant tax issues there on sort of cross-border structuring, things that we will see from the sort of advisory side. Definitely, if we're going through an M&A process and we're doing the due diligence, we'll look very closely at those structures in terms of, the management and control of them, the transfer pricing around them, any sort of other anti-avoidance issues that crop up. So obviously you have to have a robust structure that you're talking about there, Gareth, and maintain it. And at some point, that the tires will get kicked. May not be from the tax authority, but likely to be from, an advisor as they go through, the deal process. I will just reference that point around the management and control of offshore entities, because it comes up a lot, actually. It is one of those issues that people don't necessarily think about or look at that closely, but any offshore entities involved in a deal structure do need to be actually strategically driven from outside the UK rather than from here in the UK. Some other things perhaps slightly less complex is that on deal structures from a tax point of view, I think if you're just a single standalone company, it can make sense to actually establish a holding company pre-acquisition, especially if you're going to buy a company rather than business and assets. I think the holding company subsidiary structure is more robust than a sort of sole trading company that then acquires another trading company, and you try and have them as sort of parent subsidiary. So I think that structure looks good. I will also mention, and Ali, I know we've touched on this previously, from a tax perspective, we often see the use of share options. That maybe those options have been used by the target company in order to help fuel their growth and to tie people in, but they're often used as tools to actually tie in the management team. And Ali, I'll just sort of push this your way, actually, because it's something I know you're quite passionate about, is how you work with that management team and how you make sure they stay around rather than sort of leaving once the deal has been done.
Yeah, I think that's a really, really key point. You buy a business, and what are you buying? You're buying the contracts, you're buying the people that run the business. If you can't motivate those people and keep those contracts, you question what you're actually buying. It's really important, I think, personally, to get the buy-in from the people, and looking at the tools that are available. Options are great. Sometimes people have issues with handing out equity, but if you look at options, what are they about? They're about rewarding people for delivering an outcome or helping a business to deliver an outcome. And options aren't necessarily the right answer. One of the other tools I know, Nick, you and I have used recently is actually putting in bonus structures whereby when you acquire businesses, eventually when the group sells, you incentivize the key people that they get an exit payment based on the valuation achieved by the business. It's the same result. Emotionally, people are attached to say, I own a piece of the company, I have equity. But the reality is are they on the journey, and are they being suitably rewarded for helping that company on its journey? So yes, I think it's very important to do that. And most of the businesses I've been involved with, looking at the deals that have been more successful, it's where you've got people aligned and there's a common focus, and everyone benefits from doing the right thing.
I think that brings us neatly on to actually thinking about the actual advisory team that you have as you go through that deal. Ross, probably one for you. How do you sort of put together a good deal advisory team? There's different roles that people need to fulfill, and obviously there's timelines that probably need to be maintained. So how do you sort of work everything from a deal advisory perspective?
Collaboration is the key word, I think, that I'd want to insert. The key advisors you're going to need in place, external advisors, is obviously you've got financial deal advisors. So not just on financial DD, that people understand how to do deals, because it's not just necessarily understanding what the risks are, it's help structuring, essentially helping with negotiations, because if you're going into an acquisition where the sellers might be key to your own business going forward, sometimes there can be some challenging conversations. Having an external advisor that can have some of those challenging conversations can be really important. Obviously, you've got legal and the legal advisors. Again, it's having people that understand corporate, have they got the right functions, again, depending on the deal. If you've got property in there, is a manufacturing plant, having, again, the lawyers that are aware. If you're going cross-border, again, making sure those advisors are used to going cross-border, have the relationships that can help with the joined-up approach. I'd then say the ultimate point is it's not just having the expertise, it's after you get on with them. When you go into an acquisition journey, it does take time. There's a lot of time resource involved. Being able to pick up the phone, have conversations, at whatever time of day it is when something comes into your mind, absolutely paramountly important. And having that collaboration, that everyone understands what their roles are, know how they can communicate, and that makes it a lot more cohesive. The one other point I think people forget, though, is when you enter into a good acquisition, you can get all your advisors set up on your side of the fence. I think trying to help the seller have the right advisor can be important, and getting that out at the outset. A lot of the deals we struggle with is where the sellers have not got the appropriate advisors in place, not willing to change advisor, and that can cause a number of issues through that acquisition journey. So having that honest conversation with them early is also very important. Again, you can leave that to the advisor to have that conversation. We've done it on numerous occasions, and it has then certainly helped with that acquisition journey. But just my takeaway. Collaboration, though, absolutely fundamental. Make sure everyone's talking, and then also to ensure that all the advisors are working properly together is either have one of the advisors set as a lead, someone's taken ultimate responsibility for all the advisors, or have someone designated internally that again is controlling all the advisors and making sure that all the information that's coming in is effectively sieved and pushed out again to the right advisors and internally. So that's it. Make sure there's someone that's leading the whole acquisition.
And Ali, I know that you've been involved from sort of multiple perspectives. You've been purchaser, you've been target, you've been advisor, you've sort of now actually working in M&A permanently. What's your take on bringing everybody together? There's a lot involved in it.
This is really key. The last thing you want as a buyer or a seller is egos, right? It's actually getting the right people in the right chairs, building teams, building trust, actually getting the right. I'm seeing this, and I'm doing a deal in the US at the moment and one in India. Actually, the people I'm working with, the CEOs of the business, went a little bit cheap in how they were looking at who we should get to work with us. And guess what? We've had to re-engineer some of it. Why? This is the point that Ross makes. Make sure you've got the appropriate level of skill and expertise for what you need. And if you can, over a period of time, which is my approach, I've built a team of trusted advisors who I know are experienced and I know how they're going to work. And more to the point, they know how I'm going to work as well. So it's like bouncing a ball off a wall at an angle. You want to know when you throw the ball at 30 degrees, it's going to bounce off at a particular angle. It's actually building that rapport and understanding over a period of time. In addition to the legal and accounting, when you're making cross-border acquisitions, also consider commercial advisors as well. So I'll give you an idea. I'm setting up a development shop for one of my clients in India at the moment. Actually understanding Indian labor law is not something, you can apply common sense to a lot of things, but sadly in this world, common sense can get you into a lot of trouble. You need to understand the local laws. Similar situation in the US. A lot of people approach me, say, want to set up a business in the US. Normally, my first advice is, unless you've got a really good reason to do it, don't do it. It's very, very difficult. It's not one country, it's 50 states with 50 sets of laws. People don't understand that, but having the right advisors and the help can mitigate a lot of the problems that you can run into in those sort of situations.
Yeah, thank you. Understood. And Gareth, we had this question in advance, and I think it probably lends itself well to your experience. How do you scale performance? You've talked a little bit about some of the businesses that you've been sort of part of as sort of acquisitions, but how do people actually try and scale the performance of those businesses?
Well, I think hopefully through the kind of target process, you've identified from the outset what enhancement that's going to bring to the wider group, be that purely in respect of local market and expansion, or be that just building a bigger pie overall. And I think it just comes back to all the points we're talking about, which is hands on. I think you can't just expect post acquisition that things are going to work exactly as you intended them to when you were drawing them up at the outset. So it's the culture point that we've talked about from a kind of macro perspective, but it's also the real hands-on in the business, be that tax, accounting, or the actual overall commercials of the business, is ensuring that they are completely on the radar, completely being handheld in the early stages in respect of driving the outcome that was identified at the outset. And I think we're kind of talking more sort of OMB here, and I completely agree with all of the points in respect of, you'll have key individuals in that business, and it's a really delicate path to ensure that they are still motivated, be that financial or otherwise, to drive those benefits that you've identified at the outset, whilst ensuring that they're part of the I suppose the wider circle of the overall group.
Yeah, and I know, Ross, you mentioned earlier before the word patience. Patience pre-deal. I guess patience comes into it post-deal as well in terms of integrating those businesses.
Agreed, although you do need to have, you hear the word 100-day plan. Initially, you need to move quite quickly to make sure it beds in, but then you'll need some patience post that, because that bedding in process might take longer than people appreciate. And I think that post-integration piece can also lead back to how you want to structure the deal. If you're doing acquisitions that are either geographical, it's expanding customer portfolio, if you're going to be taking that new company and almost embedding it into your own, type of earnout structure you put in then becomes critical. So is it an earnout based on assessing the profits going forward? Or if you're going to be pushing these two businesses together, how are you going to monitor that? How are you going to assess that 1-2 years down the line? So you've got to be thinking about a number of components of what you want to do post completion, and that comes back to your deal structure point, and then try and keep it simple as well. So sometimes simplicity is best in deals. But yeah, patience is a key one.
Now, something that you're very passionate about is sort of getting the communication right on here. You've got talent
Absolutely
you want
right.
to keep in the business. You've got, you know, the integration piece that you've got to do well, and you've got to communicate everything, not just to your existing business, but to the target business. And you probably only get a chance to do a lot of this as soon as that deal closes.
You're exactly right, Nick. And the thing is actually finding and taking the time to go and speak to people on the shop floor. People always remember how you make them feel. If you take time, current example, the development shop we're setting up in India, our CEO flew out from the US, met all the people that we were hiring personally. The productivity and the loyalty we're already seeing from the people that we've brought on board is just immense. But you've got to think about this. This is very, very important. People, you know, the getting the deal done is, oh, we've done it, great. So what? Now the important bit, how do you execute and actually drive some value? It's so key how people miss this. I still find it quite surprising that people don't focus on this more and more, to be quite honest. And the other thing is about the deal structuring. Make sure the deal structuring is there so people understand that this is a longer term journey we're on. Very important.
Yeah, and sort of mentioning about driving value from the actual transaction. Yeah, Gareth, how do you think you should measure success of a deal? What is really that sort of key sort of barometer of success? It will probably different deal by deal, but you know, what have you seen in practice where people say that was a successful deal that we went through?
I think it comes in many guises, obviously, as we are discussing, but I think it's from the outset and that due diligence, it's the fact that you haven't missed anything. It's the fact that you've structured and you've maintained structure and you've delivered either no downsides or the intended upside from that structuring and the ongoing maintenance of it. And it's that kind of, we talk about the 100-day piece, but also longer than that. It's the look back to say, have we derived the value that we expected to derive from the outset? Have we overachieved it? Have we underachieved it? It may just be a longer burn to achieve that value, which is okay, depending on how much longer. But it's the various components within the overall transaction.
What I'm picking up here is everything is interlinked here. So when you go into the deal, you need to know what success looks like. You need to go through with tight M&A process, bringing all your advisors together. And then post-acquisition, you need to know how you're actually going to sort of drive that value and sort of bring everything together to actually sort of achieve what you intended before you went into the deal. So you can't sort of take it step by step. To some extent, you've got to see it all the way through and have that vision from the time when you go into the transaction. Ross, I know, again, you've been through a lot of deals. How would you sort of measure success?
Difficult. Very good question. I think going back to your integrated plan, I think if you've got a business model that and a plan that you set out, it's seeing that you projected what it was going to look like on numbers and also people on culture. And then 2-3 years, well, if you go a long way in the future, 2 to 3 years, are you hitting that plan? Have you retained the people you expect to retain? Have the clients stayed? Has the suppliers changed? Has it actually achieved what you had originally set out in your original plan, or ideally overachieved? That really will demonstrate a well thought through strategy. And I think to get used to that forecasting business model, looking ahead, having your thoughts down on paper, is to start that again, patience. Do that now. If you think you're going on to an acquisition journey in 2-3 years time or imminently, you need a plan now. Are you achieving that plan on your own business, let alone thinking, does the acquisition work and how do we make sure that that hits the metrics we're expecting? But predefine them, set it out, put it on a piece of paper. What does it look like? Put it in a piece of paper, make sure that the various stakeholders understand what those measures are. So if it's staff retention, make sure the HR people, that's their brief. So everyone has their targets so that there is something that you can clearly measure as you go through that process. And it's not just look at it in 3 years' time, you've got to constantly measure it because again, markets can change, economic backdrop can change. So you need it documented as you go through. So documentation and making sure the right people are tasked with the right objectives within the organisation.
Thank you. And good question coming in, actually. We just got time for to pick up on this. We haven't actually mentioned ESG, but it's very topical, clearly, for businesses. Where should that be sort of included in the deal structure? Any one of the three of you, I guess, got a view on sort of ESG and how you're seeing it included in M&A transactions at the moment, at what stage, or how it's actually being sort of dealt with?
I can jump in. We're seeing more ESG dominantly with private equity because they've got funds that need to be deployed with certain metrics. So, and that is not actually even down to the businesses they're looking at. They're actually asking what the advisors' own strategy on ESG, and we've had that with a couple of private equity companies that we've dealt with, where as a supplier to them, we've had to submit our own ESG credentials, get them to prove it. So I think it's an area that is going to become more and more important. We're starting to see more ESG due diligence start to be undertaken, certainly on the larger transactions. And where it happens on the larger transactions, that is going to filter down. And where there's external funding, again, it will become more and more important. So it's something that needs to be considered now, so that when it does become critical for raising finance, your own business hasn't then been failed in your ability to raise finance because you've not considered it either on your own business or the business you're acquiring. And on the ESG point, it's not just the environmental, the social, the governance is key. And again, that is more key when you're looking at overseas acquisitions, depending on what jurisdiction. Again, that's going to become more critical, and probably as critical for your own company's supply chains and client base, that they will potentially be looking at your own business and the subsidiaries within that group and how that impacts the whole ESG piece. So yeah, fundamental.
Thank you, Ross. And clearly we picked up on a lot of things in the last sort of 40 minutes or so. We're just working our way to the end, and perhaps I can ask each of the three of you just to reflect on your key takeaway from the conversation. But before we do that, we're just going to launch a poll just to get some feedback from the attendees. Okay, I haven't sort of seen the results of that come up on my screen, but thank you to everybody who provided some feedback there. So I'm just going to work across my screen really from left to right, and just, as I say, just ask for your key sort of takeaway, key top tip, do's, don'ts, perhaps, in terms of this acquisition process. Gareth.
Thank you. I mean, I'll read out the points that I'd written down pre this, and all of them have been hit during this conversation, and that's great to see. We've all got the commonality of experience in respect of M&A. I would say start structuring, planning, and due diligence as early as possible, and understand the art of the possible for all parties. It's never going to be perfect, or very rarely perfect. Once heads of terms are signed, maximise target engagement, but acknowledge that they've got day jobs as well, and will have absolute competing priorities. RAG the risks. Only deal with the ones that matter. It's not about ticking everything off on a due diligence list. Strong management of timetable we've picked up on, and advisors. Regular catch-ups. I've had transactions where we've had morning and afternoon catch-ups daily. Ensure the messaging is aligned, and most importantly, from an integration perspective, boots on the ground once completed.
Fantastic. Completely agree with all of that. And Ross, perhaps you can give us your key takeaways.
Yeah, completely echo that. Make sure you're ready. Understand your own acquisition strategy, fundamental. Get your advisors in place early and make sure they all understand their respective roles. And then probably the most fundamental to make that acquisition actually work, make sure the right people have been tasked with the right assignments to be able to do that post-acquisition because that's when the really hard work starts, is that post-acquisition. And don't lose sight of that.
Thank you, Ross. And last but certainly not least, Ali, your takeaways.
Thank you. Yes, I would agree with all of that. I'd add two more things. Don't be afraid to walk away if the deal's too rich. What I find is sometimes if people invest a lot of time and energy and emotion into a deal, they can sometimes lose sight of that commercial outcome they're looking for. And I have seen people overpay and overpromise on deals, and it isn't right. The other thing, the fundamental thing, is business is about people. Think long and hard about the business you're acquiring and the people that are going to be part of your new collective. If you have a feeling and you're not seeing behaviors, you're not seeing alignment in their outlook on what they want to do, that's again a very, very big red flag for me. People are very important. So even if a deal looks sweet financially, if you're bringing in personalities and people that are not going to align or sit well, that's going to put a lot of strain on your management resource and time trying to manage that. And very key point to me.
Brilliant, thank you. And I have to say, so many pearls of wisdom have been sort of, spread across the last 45 minutes. Hopefully, the attendees out there have picked up something from the discussion. I certainly have. Obviously a lot involved in the process. So thank you, Gareth, Ross, Ali. Really appreciate your time this morning. To everybody who's attended, thank you for joining. We will share a recording of the webinar afterwards, and it just leaves me to close and wish everybody a very good day. Thank you very much.